Let's talk about the intersection of climate change and finance. Climate finance needs are forecast to rise sharply to about $5 trillion a year globally by 2030 in order to fund measures designed to fight climate change. Researchers from 5 green groups say that progress is lagging in pretty much all sectors, including transportation, agriculture, electricity. And they say that the world may not reduce emissions at the pace required to limit global warming to just 1.5 degrees Celsius in order to avoid its worst effects. None of the 40 indicators assessed in this study are in line with the 2015 Paris Climate Agreement goal of reining in the average temperature rise to well below 2 degrees Celsius and ideally 1.5 degrees above pre-industrial times. At the same time, the UN Conference on Trade and Development have published a report indicating that the annual costs of climate adaptation in developing countries could go as high as $300 billion in 2030. If mitigation targets are breached, those costs could rise to as much as $500 billion by 2050. All right, then let's explore this in a bit more detail. Richard Kozel-Wright is the Director of Globalization and Development Strategies Division at the United Nations Conference on Trade and Development. UNCTAD. Richard, thank you very much for your time this evening. When we talk about funding, though, I mean, we've heard past promises of funding over and over again, and these rarely ever have actually been materialized. Should policymakers be taking these promises that we're hearing now any seriously?
Yeah, good evening. Well, you're right. I mean, developing countries have grounds to be skeptical, and UNCTAD is an organization that established the 0.7% ODA target back in the early 1970s, and advanced economies have never reached that target in total. It's now just 0.3% of their gross national income. So, I mean, there's a history of skepticism that is justified. I guess there are some reasons to be a bit more hopeful in the current climate. Obviously, the pandemic has shown that that advanced economies have the ability to mobilize trillions of dollars when push comes to shove and they're facing their own particular crises. That's what's happened during the pandemic. And so I think we should take some hope from what's happened during the pandemic. There are some other things that are happening. Debt relief is back on the agenda, and debt relief has to be part of any financing strategy for developing countries. And there are signs that, the initiatives like the HIPC initiative from the 1990s might be revived again. The IMF has launched a very large new issuance of what is called special drawing rights, essentially the money that the IMF creates. So $650 billion was created at the meeting last month, and so there are mechanisms out there, we think, that can be mobilized to meet the kinds of targets. And as you rightly say, the $100 billion that has been talked about in Glasgow is not sufficient, but there are mechanisms out there that can be mobilized, we think, to hit more ambitious financing targets going forward.
All right, let's work with what history has shown us, right, that the funding may not necessarily come. So looking at sub-Saharan Africa collectively, not many of these economies have long-term pools of savings available. But beyond those, what other domestic sources of capital can they deploy in order to essentially meet these climate investment targets? Can these countries do it by themselves?
It is, history is not a great guide here, but it is the case that in many African countries, rates of capital formation, investment levels, were higher in the 1970s and 1980s, at least as a percent of their income, than they are today. So when if we're talking about raising the rate of capital formation of investment by 2 or 3 or 4 percentage points of GDP, we have some examples from history from the region that say that's possible. Governments need to raise more from taxes. There needs to be taxes on high wealth individuals. The Pandora Papers suggest that there is money there to be mobilized. Illicit financial flows have plagued African countries for decades, particularly illicit financial flows from large multinational corporations, and we need to rein that in to make sure that African economies have access to those resources. In the work that we do, we see a very positive role for development banks. The old mechanisms that were used back in the 70s, 60s and 70s to raise investment rates need to be revisited. There are strengths and weaknesses with those mechanisms. We know we need to take the good lessons from China, for example, where development banks have been critical to raising their investment rates, and learn from those and adapt them to the specific conditions of Africa. But there are certainly, I think, opportunities there. Local bond markets might provide another source of revenues. I mean, we would emphasize that the external constraint and the access to external financing is critical, but there are things that at the domestic level that governments can do to begin to mobilize domestic resources to raise their investment rates in both adaptation and mitigation efforts.
Indeed. Let's go to that, because back in May, UNEP, the United Nations Environmental Programme, they argued that we need at least $200 billion a year invested just to deal with forests restoration and agroforestry. Now, the ecological services provided by forests around the world, we've known this for a very long time, the benefits of the Amazon, the rainforest over in the Congo, but investing in them as an asset class is still deeply problematic. Is the problem here that, yes, we know what the problem is, we know what the solution is, but converting that solution into an investable asset, for lack of a better word, is proving to be difficult?
Yeah, I don't think the kind of returns that you can get from forest services are not the kind that asset managers are looking for in this kind of highly financialized, short-term financial market world. So I don't think you can rely on private capital to be able to make the kinds of investments in forests that you're talking about. The sad thing is that the public initiatives like the the reducing emissions through stopping deforestation and degradation of forests has not been effectively financed. That's certainly the case. And so, I mean, as you rightly say, forests could provide an important carbon sink and an opportunity to deal in part with the problem, but the financing certainly isn't there. But I wouldn't rely on private financing to fill that gap in that case, I have to say.
Indeed. One last question for you. Something else that at least finance managers do look at and say, okay, there's a return here. Coal, that's now becoming essentially a pariah asset class in some parts of international finance. Oil and gas arguably getting there as well. But gas is needed as a sort of transition fuel, right? As we essentially make this transition to getting away from coal, we need to have a bit more money flowing into LNG. How do we avoid making LNG a stranded asset, given this whole aversion to fossil fuels?
Well, I think the question of stranded assets needs to be put onto the negotiating agenda. It hasn't really been sufficiently talked about, and liquid natural gas is probably the lowest carbon intensive of the carbon fuels, but it's not a solution to the problem, obviously. I mean, the International Energy Authority, in its report that was released earlier this year in May, has basically argued if you want to kind of hit the targets that you mentioned earlier in the presentation, then we can't invest in carbon fuels. But that's realistically, we have to move in a systematic but sensible way. Maybe liquid natural gas can provide something of a bridge, but I think we need to have a serious discussion about stranded assets, and that's an issue for many African fuel producers. If we're going to make any progress in terms of finding a just transition for economies that have become heavily dependent on exporting fossil fuels. So I don't think LNG is not a solution to this problem in a long-term sense, but the issue of stranded assets has to be on the negotiating table.
Indeed. Let's see how this all plays out over in Glasgow. Richard Kozel-Wright, Director of Globalization and Development Strategies at UNCTAD. Thank you.